Hey, in case you have student loans, car loans, and credit cards, you're not alone. Today, in this video, I want to explain to you, what is debt? What's the difference between bad debt and good debt? You'll also learn all the categories of debt. And finally, you'll know how to pay off debt by using these strategies. Let's jump into it. Let's start from the beginning. What is debt? What is debt? Debt is when you owe anyone money. Maybe you're still making payments for something you bought. Yes, my friend, that's also debt. In simple words, debt is money borrowed from another party for something you can't afford. Maybe you purchased that nice car before you had the cash. Bad. Or maybe you borrowed money from your stepsister because no one else would give it to you. Debt simply means you're at the mercy of someone else until you pay them back. When you have debt, you're no longer working just for yourself or your family. You're working for whom you owe money. Debt comes in many shapes and sizes. No matter what type of debt it is, bad or good. Debt just steals money from your pockets and your future. It's time to take back control of your money. Certainly, no debt is good. However, there are two types of debt: good debt and bad debt. Bad debt and good debt. Bad debt. Let's start off here. Bad debt involves borrowing money to buy things that lose value rapidly or for the purpose of consumption. If it does not generate income or does not increase in value, you definitely should not go into debt to buy the item. Here are some examples. 1. Cars. Do we all agree that borrowing money to buy a car is a bad debt? It is, first, not a good choice from a financial perspective. Let me explain to you. You may think buying a car is a big deal, but after the purchase, the car is worth less than what you bought it for. In case you urgently need to borrow money to buy a car, look for a loan with low or no interest. That way, even if you pay for an asset that will lose value over time, at least you won't be paying interest on it. 2. Clothes and consumables. Did you know that clothes are worth less than half of what consumers pay for them? We all need clothes, food, and so on, but getting into debt to buy brand new shoes from Gucci is a very bad idea. Now, let's look into good debt. Basically, good debt has the potential to increase your net worth, or, more importantly, enhance your life. In other words, it takes money to make money. Good debt is the debt that can help you generate income that can build your net worth. A couple examples of good debt are: 1. Student loans. It makes sense because the more education an individual gets, the greater their earning potential. An investment in education can often pay for itself within a few years of entering the workforce. However, not all degrees are of equal value, so it's worth considering both sides. 2. Mortgages. Yup, this is considered a good debt. Mortgage debt historically has been considered one of the safest forms of good debt, since your monthly payments eventually build equity in your home. But pay attention. Borrowing more than you can afford, or using mortgage terms you don't fully understand, such as adjustable rate mortgages, also known as ARMs, can pose a significant risk. For example, your monthly mortgage payment should be less than 28% of your gross monthly income. 3. Business. Getting into debt to start your own business is considered a good debt. Being your own boss is satisfying, not only financially, but psychologically as well. But it can also be very hard work. Also, consider the fact that the risk of failure is not zero. Data from the BLS shows that approximately 20% of new businesses fail during the first 2 years of operation, 45% during the first 5 years, and 65% during the first 10 years. Only 25% of new businesses make it to 15 years or more. So before getting into debt to start a business, think about this twice. However, your chances of success increases if you choose a field you're passionate about and knowledgeable about. Categories of debt. Secure debt. You just walked out of the dealership, driving the car you dreamed of last night. You can't wait to show it to your friends and family, but there's a problem. Actually, that car is not yours. The bank owns that car. You're paying the bank to drive the car. This is a simple example of a secured debt. Now, let's look into unsecured debt. Unsecured debt refers to money that you've borrowed and where there's no collateral in case you don't make your payments. For example, a credit card is an example of unsecured debt. If you go out and you charge dinner at a restaurant or you buy something at a store and you don't make your payment, the credit card company is not going to come collect on that. There's nothing for them to seize in the event you don't make your payment. Student loans are another example of unsecured debt. If you have a student loan and you don't make your payment, there's no collateral there for the loan. It's money you've borrowed, but it's not directly tied to an item. This makes it harder for the lender to get their money when you don't pay up. Thus, unsecured debt usually has a higher interest rate. Revolving debt. Revolving debt basically is your credit card. You can borrow up to a certain amount, and as long as you make the minimum payment by a specific date each month, you can keep spending. Non-revolving debt. Non-revolving credit doesn't change. Your payment is usually fixed, and the amount that you borrow starts off at a certain amount and then it decreases. It never goes back up. There are different types of non-revolving credit to go into, but it's essentially credit that doesn't go up, so it's a fixed dollar amount that you're borrowing and you're reducing every month. It's a debt that can't be used more than once. It's a car loan, a business loan, a student loan, or a mortgage. You borrow a specific amount of money and pay it back in installments before a certain date. And your minimum payment each month usually depends on how much you originally took out. Once you've paid the loan off, it's gone, and you don't get any more funds to spend. Sneaky debt. These sneaky debts. Pay attention here. Computers, cars, motorcycles. You've probably seen the flashing neon signs. 0% APR, annual percentage rate, or 90 days the same as cash. Salespeople know most people can't pay it off within 90 days, and the moment your time is up, crazy interest rates kick in with full force. Good advice would be, don't fall for these debts disguised as deals. They're not worth it. So now, how do you pay off debt if you have any? Well, 1. Make a budget. It's fundamental to track your expenses and income you need to understand where your money is going. You can manage your money by using the 50-30-20 rule. Let me explain to you what it is. 50% of your money is for your needs. Need is something you cannot live without, which is food, mortgage, insurance for health, utilities, and so on. 30% of your money is for your wants. Want is something that you don't necessarily need, but it improves the quality of your life, which may be dining out, shopping, hobbies, and so on. 20% of your money is savings or paying off debt, which may be student loans, credit cards, etc. 2. Debt snowball. So essentially with the debt snowball, it's basically listing all your debts in order, from smallest to largest by dollar amount. Here's how it works. Your goal is to pay your smallest debt first, regardless of interest rate. Then roll the amount you'd been paying on it into payments on the next largest. Step 1. Only the minimum payment on all your accounts. Step 2. Put as much extra money as possible toward the account with the smallest balance. Step 3. Once you finish paying the smallest debt, take the money you were putting toward it and funnel it towards your next smallest debt instead. Repeat all 3 steps until all your debts are paid. This method is very efficient because it includes a series of small successes at the beginning, which will give you the determination to pay off the rest of your debt. There's also the potential to improve your credit scores more quickly with the debt snowball method, as you lower your credit utilization on individual credit cards sooner and reduce your number of accounts with outstanding balances. 3. Avalanche method. What the debt avalanche talks about is that you want to pay off your highest interest debts first. So the reason for this is because mathematically, that's actually the most efficient way to do this. By using this strategy, you'll pay off your accounts in order from the highest interest rate to the lowest. Here's how it works. Step 1. Again, only the minimum payment on all your accounts. Step 2. Firstly, pay as much as you can on the account with the highest interest rate. Step 3. Once the debt with the highest interest is paid off, start paying as much as you can on the account with the next highest interest rate. Repeat and continue the process until all your debts are paid. That way, you'll get out of debt quicker because you're paying firstly the debts with the highest interest rate. 4. Halt your credit card spending. Are you a compulsive shopper and can't control yourself? Next time when you leave the house, leave your credit card at home. Stop spending with your credit cards until you have your finances under control. 5. Change your habits. Stop for a moment and think about all those unnecessary things you buy. All those things are part of the wants list. Maybe you smoke or pay Netflix every month. These are all unnecessary expenses that are taking money out of your pocket. Do you really need your daily cappuccino? For example, you can prepare your lunch for work at home instead of buying it every day. Ask yourself, what can I change without sacrificing my quality of life too much? 6. Never use debt again. Before borrowing for a new house, a new car, or student loan, stop, breathe, and ask yourself a question. Will this debt pay me back more than what I put into it? The question may seem simple to you, but you need to think very carefully about it. It's definitely worth asking, instead of drowning yourself in unpaid debt. I suggest you write down a list of pros and cons. If the result doesn't satisfy you, then it's not worth it to go into debt. Conclusion. Most of us spend a bunch of dollars without actually thinking about what we're buying. Log all your monthly spendings, cut back on things you don't need, and start saving the surplus, or put it towards reducing your debt. Thank you for watching this video. I hope I've helped you to understand better what debt is and how to get rid of it. I'm really curious to know what you think. I have a question for you. What method would you use? Avalanche or snowball? Let me know in the comments. Thanks for watching, and I'll see you guys in the next one.